Brian, I'm going to make the assumption you can hear me. I'm gonna give Brian 5 to 8 minutes today to go through a couple of your questions in regards to the. And you know what, Brian? Maybe we should start that way. Brian, what do you think about starting with
I'm
you
happy to do
giving
that.
your explanation? Let's do that. So I'm gonna make Brian a presenter, and maybe let's just start that way. All right, Brian, take the screen over. It's all you.
All right. I wanted to talk about a little bit about my strategies. Because I'm a volatility trader, I try to trade non-directionally. I'm trying to make money off of big changes in volatility. And some of you I've done a little bit of trading in some of your accounts, and some of you have seen this FCX straddle. A straddle is my favorite non-directional strategy because it has unlimited profit potential and a little tiny risk if you know how to buy the options cheaply. And so a big part of making sure that I'm buying options cheaply is just knowing, being able to value the options. I use a software right here. This is Odds Analytics, and if you go to oddsanalytics.com, we can provide a link for you here. Right now, all this stuff is free, so you can click right here to get into the analytics distribution, and you can do some analysis yourself. And what you're looking at right here, the green line is the log normal bell curve distribution. It's no secret, right? The Black-Scholes model, almost all option pricing models assume that the market's future price distributions are going to follow a log normal bell curve return. And that's because you have to make some kind of assumption that the market is going to be in some sort of a price range in the future in order to value the options. Well, what we have here in this blue histogram is the stock's actual distribution in the past. Right now, it doesn't have to follow the past distribution, but history tends to repeat itself pretty often, right? And that's one of the reasons why I love this FCX trade. I look for FCX because I've made some really good money on using straddles on this particular asset. And so what I'm showing you right here is this is the day that we entered the trade that are in some of your accounts back on September 18th. And this is what the distribution looked like at that point in time. If we change this and update it so that we're looking at yesterday's data, or let me try that again. At the current data, you'll see that the options are no longer super cheap. In fact, that bell curve matches almost perfectly right there. And what I said last week is I'm not interested in fair options, right? I'm only interested in buying them cheap. And so this has changed, and this is going to change all the time. We're looking at current data. When options are cheap, I like to buy straddles. And then how do I exit them? And that's the questions that came up. And I want to talk about that. Let me go back here. So past FCX trades, and I'm going to take you into so the first thing I want to talk about is, now this is not FCX. This is Protein Design Labs. And the reason why I'm showing you this is I learned an incredibly valuable lesson. And so I started working for Don Fish back in 1998. So this is a year after I started working with Don. We bought a straddle on Protein Design Labs, somewhere in this area right here where all these little arrows are. Stock's trading around $10 a share. And these prices are all price adjusted for, they've been adjusted for stock splits and all that kind of stuff. So they're not exactly what they were back when I got into this trade. But I waited for about 3 months, and you'll see what happened here is the stock goes up, it kind of rolls over, and some people are tempted out, you know, when you get at this peak, they're tempted to go ahead and sell. We didn't. We held on to it. And you keep going along, and it makes another nice big gain. And this one was really tempting to start getting out. And especially when it started rolling over right here and coming down, it was really tempting to get out, but we didn't. We held on, and we got some more, and it was really tempting here to get out as it turned over and started to roll over that top, and we didn't. We kept holding on, and it paid off, and it kept going and kept going. And right here, I had a couple days down, and this day was, you know, the stock went from $10. It's up around trading over $30 a share, around 33, and this next day is Wednesday. And the reason why I show that bar is because in the morning before the market opens, Don Fishback and I are talking. We're thrilled because my $700 straddle trade is now worth about $7,000. So we're up 1,000% on this trade. And in the morning right here, the bid-ask spread on the options was huge. And we were trying to figure out exactly, you know, what we're going to do. The market's going crazy, and we just decide in the morning, let's go ahead and just bail out. And we can't wait to tell all of our newsletter subscribers that we ended up getting out on this. We gave them the signal to go ahead and get out. We got out after the market opened, and we looked so stupid by the end of the day, right? So we're thinking we're brilliant because we're up 1,000% in our trade, and we think we're brilliant, but the stock goes from 33 up to 52 change at the high. And again, these prices have been adjusted for splits and things, but so not the actual prices, but the stock just embarrassed us because we got out in the morning and we didn't let our profits just run. And I'll never forget this lesson that I learned, because Don Fishback is like, all right, every time I call the office from now on, you're going to answer the phone and say, how high is too high? And that was just, it was a painful lesson. We looked really, you know, we had 1,000% gain. We were so excited, but we left so much money on the table because we thought we were able to call a top. And we didn't call a top here. We didn't call a top here. That would have even been more embarrassing, right? But the whole point, and the reason why I'm talking about this, you've probably all heard the statement, cut your losses short and let your profits run. Well, there's journals and articles and tons of research has been done to show that that's a good idea. And that most investors, when they enter trades, we do an inordinate amount of research to find good entry points. And in general, not just professionals, but retail investors, we all pick pretty good spots to get into trades. But what we're terrible at is, and I shouldn't say everyone, but I should say that the research has said that professionals and retail investors alike are terrible at their exit because they don't spend the same amount of research and time and effort on choosing their exit strategy. They tend to exit based on emotional reactions to events as they occur. And so that's kind of what the research shows. One of the things that's what I learned here. So when you think about this, cut your losses short is about exiting the trade. Well, I hate exiting a trade when the profits are going to keep on going, right? And so my strategy is to only invest the amount I'm willing to lose. And with a straddle trade, the cool thing is that I've seen you can't take a max loss on a straddle trade unless the stock closes at expiration right on the strike price. That's where you take a max loss. And I've seen it happen. It's happened 3 times in my nearly 30 years of trading that I've seen that happen. But I wasn't in any of those trades at that period of time because I'd already pulled some money off the table. But that said, the goal that my strategy in exiting this trades, and I learned that lesson right here, is to let your profits run as far as they will. And on this day, we just like, the stock's doing exactly what we wanted it to do. It's all working in our favor. Why on earth would you want to get out? And well, we just wanted to book those trades. We wanted to call ourselves a winner so bad, and we were up so big, we didn't want to give anything back, and we ended up taking, and what we could have done, or what we should have done, is maybe rolled up or used a different strategy to stay in the trade. So we could have taken some profits off the table without completely exiting the trade. And so that's what I've done with FCX. For those of you that are in this trade, I'm going to show you this trade. I'm going to show you some past FCX trades and why I really like this stock. So here's where we got in right here on this line. Stock's trading kind of flat. We got some signals over here that were signaling that volatility has gone down. And if you look down here at the implied volatility, you can see the options are very cheap right there. And so we got into the trade right here, and then we got this big, nice drop. So what happened? Well, the company changed their forward-looking guidance, and they lowered their guidance. And that to me was exciting. Okay, we're going to get some big move off of this. We did get a couple days of big move, and then it started bouncing back. Now, what I'm looking for, so I give myself permission to take some profits off the table when the stock has made something above a 1 standard deviation move. And so these lines right here are an indicator that I've developed. I'm not ready to share it exactly right now, but it's, instead of using historical volatility of the stock, it's looking at the implied volatility of the stock and creating bands based on the forward-looking estimates that people who are trading the options are looking at. And you can see right here, it crossed over the line. And this is my strategy. If you're using technical analysis, it's a lot like Bollinger Bands. When things get outside of a band, you don't necessarily go ahead and get out right then, unless the stock has a history of bouncing off those lines and going down, or in going and pulling back. I wait until it crosses back inside of those options right there, which it did on this day. And the other thing that I always look at is I don't just want a set of rules and say this is what I'm going to do every time. I want to have as much information as I can. And on this day, I'm going to share this. This happened, right? Bank of America upgrades Freeport McMoran from to buy from a neutral. So they determined that the stock has moved down sufficiently that it opens up, that maybe it's value investing. You want to buy when it's cheap, right? And that makes sense. So right here at the end of this day, I see that they made that. We crossed the line at the close. And so on this day in the morning, I didn't get out completely. I rolled down to this strike and took some profits off the table. And just in case it pulls back and goes all, it could come back up. We could make money on the put side and we could make money on the call side, which is great. And so we're still in this. And here's the thing is, this is because of this big down move was because of forward guidance going down. Well, that's interesting because their earnings are coming up right here. So what are their earnings? What's their earnings report going to say? Is it going to be bad news? Could it keep going down? And that's why I don't want to be out completely on the downside in this yet. And so I'm still hanging on. We took some profits off the table, but still hanging on to go down. So I can show you back here what happened the last time I got into a trade here. Come on. It was last year about the same time. Yeah, there we go. Not last year, 2 years ago. Sorry, 2023. So around the same time. So this year we got in on September 18th. This was September 19th when I entered this trade. And you can see we have a nice downtrend. It did something similar where it went down pretty good, crossed over that line, pulled back up, came back down, kind of crossed over that line again, pulled back up, and it didn't stay below the line very long, but it kept going down. I just held on to this all the way to the end, and it resulted in a nice profit. The previous time before that, I got to go clear back here to, I think it was 2019. Oh, there it is. Is that the end? Yeah, there we go. So in 2019, so and this is more of, you know, the same kind of thing. I'm trying to let our profits run. So this time I got in on the 18th of March, and the stock did move up. And the funny thing is, it didn't cross this line and get out. So I didn't take any profits on the call side, but I did hang on to it all the way down here, and we ended up making a nice profit to the downside. So that's, I want to always have good reasons for doing the action, taking the actions that I take, and I build in the risk ahead of time to make sure that I can let my profits run. And if you think about that saying, when you let your profits run, they're not talking about exiting, they're talking about staying in. And so that's why I do things the way that I do, and I want to use up that time and let my profits run as far as they will. All right, I hope that's helpful, and I'm going to turn the time back over to Kevin. Let's see here. Do I have to make you a presenter again, Kevin?
I think I think I took it over again. So let's make.
Oh, you got it. Yep.
There we go. All right. So I've got some information in here for you from what Bryan was saying, and the short answer is, and I love how he's saying this, but I'm going to translate it into the way I view it. Basically, Bryan, let's not call you he's. Bryan is running the Straddle Strangle. Got to get rid of that. All right. Good thing I type very well, right? For heck's sakes. Bryan is running the Straddle Strangle. And the best way to say it is as a process, where he's looking, and it's the first time I've heard someone talking about rolling it down, resetting the trade, maybe taking one end off. He's just running the Straddle Strangle as a process. We've talked about forever, if investing is a process, can't type worth beans today. If investing is a process, we have the opportunity to adjust, right? If investing is just a singular event, you have a 1 out of 3 chance of being right. And another way to look at that is, or a 33% chance of success and a 66.6% chance of being wrong. And it's interesting to hear someone talk about non-directional, because non-directional allows you to make money just like the collar trade. But again, the collar trade's a process. On the way down, you make money up, add more shares. on the way back up, you make an explosive return. So it's neat to see someone that is taking a straddle strangle trade and choosing to run it as a process, much like we run our collar trades. It's something that's, I think, in the long run, will be very profitable for those smaller accounts. And that's an area where I think volatility that Bryan's learned through Don Fishback will be really helpful for those smaller accounts to get those up in those areas where we can collar trade them. And again, have years like we're having this year. A couple of you have asked me, what's next? And the short answer is, let's face it, nobody knows. So my simplest way to say something to you, what's next is earnings. And we're going to prepare for earnings, and we're probably, because options are cheap right now, probably because those options are cheap, we're going to protect early. Usually we do it a week to 2 weeks out. We might do it 2 to 3 weeks out. We're going to try to protect early because options are cheap. That's our goal for right now. How quickly can we get protection on? Because our options seem to be fairly, if not discounted in price. What that typically means, we may run out of the money options for this earnings cycle. And the reason why we're more willing to do that versus at the money, maybe 1 to 2 strike prices lower, this is your Christmas rally. This is where people this year that don't have your kind of returns are looking for pushing the market higher. With Micron today, I mean, what a day. With Micron today, NVIDIA, Meta made a round trip. Yes, I'll be 100% honest. Keeve and I were talking about Meta this morning and what a pain in the butt it's become. But we've got Google that took off. Micron was up over $9 at one point today. It did pare back, but it ran all the way up to 200. So we now have a price point that it gets back up to 200. We're just protecting it. Really, it's like 199, I believe. Let me check for you. But again, up another $1.34 after hours. Micron's highs were, it actually hit 201 today. So it's kind of neat to see some shuffling in funds. Meta was below 700 today. We are seeing right now, we are seeing the rebalancing for a Christmas rally. Taking shares off the table now at a lower price, looking to see them go up. It's just something that be ready for a pretty good run. And then our fear is we're going to have a pretty good recession or pullback. So we're looking to be very protected, if not fully collared, going into January of next year. We're also looking to define, how would I say it? We want to take those profits off the table and be a little cash heavy running into next year. Now it's funny because Abraham says, how do you define options are cheap? And it's really volatility. When volatility is low, those options become significantly cheaper. Right now, it's really hard to find the credits. 4 and 5 weeks ago, we were doing pretty good. We were doing pretty good at getting some credit. The pricing has just gotten cheap. So we're looking to capitalize on a lower than average VIX. We're looking to see on balance volume. The 5 days last week, we should have had a couple days that were down. Kevin, give me proof that we're going to go through a Christmas rally. Last week was it. We should have had some pretty good down days, yet the market kept pushing higher. So those are some things that I'm looking at that are judging about my thought process, or they're affecting my process. Maybe not judging, but they're affecting my process on what I see happening and how I want to run that going into the future. Let's see here. I've got most of our earnings set here so that you can see them. It's Bank of America and JP Morgan next week. In fact, usually you see possibly 3 weeks of financials that come through. This earnings season looks like it's 2. So we have some huge financials coming up next week. Bank of America, JP Morgan. We might look to put some money into Key Corp because it's cheap. Goldman Sachs, Morgan Stanley, Wells Fargo. All the big bellwethers are reporting next week. But I've got our earnings schedule up for those that we follow. There are some that are estimated there. We're going to protect early. We protected last week for Bank of America and JP Morgan. We might be protecting next week for, well, I didn't put Google in there. Google's an estimate. We're going to be looking to protect probably a couple weeks early because of the pricing for options. As we look at the big picture, a hot stock market could be running headlong into Warren Buffett's call patience. The valuations are high, and on average, the valuations compared for most models are getting, it's screwing up every single model. I believe I told you 2 weeks ago. Would someone tell me why we might have a new normal on the valuation of the S&P 500, where 17 to maybe 19 or 21 is no longer the average, the high end? Someone tell me why might we have a new normal on the price to earnings for the S&P 500? Why might we have a new standard? Weak dollar. P500 valuation. So Mod said the weak dollar. That would have a bit. Inflation kicks in. So it's interesting because both of those comments hurt the valuation and normally lowers it. Now the weak dollar can do both, but inflation kicks in, valuations go down because everything else goes up. Weak dollar historically hurts the US for US based companies, but it helps those that sell internationally. I like both of them, but I'm not sure I would agree with either one of those. And again, definitely not the inflation. The weak dollar, it's a coin flip. I get that one. But we're looking at new valuations. We put, actually, let's not put that because we didn't do anything. The government put trillions of dollars into companies' pockets. Also, we have a handful of trillion-dollar companies that are changing the valuation / price to earnings index metric. And last but not least, My opinion, and this is kind of going out there a little bit, we've had stretched valuations for decades. In all reality, we should be stopping, we should be paying attention to the most recent data. There's no reason to go back to the 1950s. The 60s, 70s, 80s, 90s were not like today. The data from the 50s, 60s, 70s, not important. The chart patterns don't match. Well, we're definitely in a bubble. This is reminding me of 2000. That doesn't add up because in 2000, you had 25 IPOs of companies with zero earnings. And now you have IPOs of companies with hundreds of billions of dollars of earnings. The new standard, most likely for the S&P 500, should probably be 22.5 future times earnings. It's going back to 17 to 19.2. Dividends reinvested in M&A. It's a joke. There's no reason. It's funny. All the models that are calculating anything pre-2000s are off significantly. And it's because it's a new normal and they're new numbers that the averages of the past are so far in the past that they truly don't matter. It's interesting that you keep hearing this spoken of, especially on TV. But here's the catch. If you're not invested in the stock market, you are sitting on a fair amount of cash. It mentally can be painful watching stock prices appreciate nearly every session. And when they don't, not pulling back much to get in to buy the dip. It's an understandable tendency to want to put that cash to work. Here's the catch. Are you buying into something that will go up in the next 6 to 12 months? It's very interesting because in this last paragraph, I hope you read it. Fear is a motivating factor. Their comment is, but fear is not a virtue. Patience is. He's been sitting on a large pile of cash for years. And he's chosen to sit on that cash. Well, he's making up, okay, yes, he's making his biggest purchase ever, biggest purchase in the last decade. But for over 3.5 years, he gained a pile of cash. We're doing excellent. Some of you are doing excellent without even being fully vested into the stock market. That's okay. Take your gains, be happy with it. All right, here we go. Looking at the Dow Jones Industrial Average. Looking at our chart patterns. Looking at what we look at. RSI just nudged up against 70 and pulled off a little bit. Our 50-day almost looks the same in the price from the 50-day to the current price, from the 50-day down to the 200-day. For a while now, the MACD's been laying on itself. 12.26 and 9-day. 12 and 26 average together on that 9-day. We're pretty much flat. And on the Williams percent R, my medium stochastic, new money's not really coming in right now. It's kind of funny because if you look at it, that means a lot of our movements here have been retail money, not institutional money. Now that's just the Dow Jones. That's your TV index. This index doesn't mean much of anything. On the flip side, the S&P 500, we just dipped into overbought. 71.48, $1.48, overbought. We're still creeping higher. What I like, distance between the 50-day and the 200-day, and distance between the 50-day and the actual price, you have twice as much distance down here. Sometimes when you see deviations, standard deviations, where the 50-day leaps higher, significantly higher than the 200-day, you get model pullbacks. You get models that sell off the S&P and pull back because the models are taking a profit. Big money's in, and again, we still have the 12 and 26 average against the 9-day right on top of each other. Can we still go higher? Typically, we don't. Earnings are going to make the decision. Earnings last time gave us a pretty good run up. All right, here we go. Looking at the NASDAQ. Slightly 0.93 overbought on the RSI. Again, I like the distance. We have room to grow as a standard deviation from the 50-day to the current price, but the standard deviation from the 200-day and the 50-day is also growing. Same thing, MACD laying on each other. Big money is invested. Little drop here. A monthly sell-off. You can see what the bigger drops are when you get a rebalancing at the end of a quarter, although that's August. We probably had most of our rebalancing in August for the quarter of September. Big money's not expecting this to go this way. In fact, looking at it, we basically had a triple top. We have a head and shoulders pattern there. And our market keeps marching higher. Thank you, MAG 11 to 17. Yes, again, it comes down to 0.1% of the stocks. As a market cap, I think it's bigger. I think it's 4.3% of the S&P NASDAQ market cap is moving our markets. That's why we're in it. And I thought it was kind of funny because for the most part, big news is saying, hey, this can't go on forever. And my comment is, no kidding. Duh. Of course it can't go on forever. But it's going on right now. And because it's going on right now, you can be a contrarian and get your butt handed to you, or you can follow along and make a pretty darn good profit. S&P 500, we're going slow. We're going just 2%. Yes, I thought the S&P would be 2% for the last week of September, was a little bit higher. Earnings, no earnings to speak of. McCormick, Delta Airlines, Pepsi, and Levi on Wednesday, no real earnings to speak of. For this week, our most important economic report is probably going to be the FOMC minutes. Will the Fed really cut 2 more times this year? If they do, we're looking at the October, 28th, 29th rate cut. We might get a rate cut in December. We will not get a rate cut on the November meeting because they don't do a press conference. All right. I found an interesting article. I think I've put a couple out here, but an interesting article on Europe's work balance. A key town draws Trump vamps up the H-1B visa. It's funny because if you're looking for a job and you ask an employer what their employees think a work balance life is at that company, you're not getting the job. They want to see that you are all in on the company. In the US, it's still a work in progress where that first 2 to 3 years, you work your way up the chain. I find it interesting. There are other countries that are more interested in the work-life balance and are offering that. The United States does not do that very well. That is a key for more people to stay overseas than to come into the country. Very interesting article based on some comments made by Paul Tudor Jones today. He thinks we're in for a massive rally. Chances are we're getting to 7,000 at the end of this year. But then we'll have a blow off top to our bull market. It's funny because I just highlighted a couple things. People are eager to capture outside gains and embeddedly of a painful correction. They're more interested in the gains than the correction that we're way late on. They'd rather take those gains and run with them. It's shocking on how far we've run. With that said, even the professionals are thinking we'll have a Christmas rally. This is why we're going to want to be fully collared into the beginning of the year. Goldman Sachs CEO, overextended AI craze puts stock market on a risk curve. The returns are ridiculous. We're talking about a bubble again. Am I worried? Kind of, but not really. Am I disappointed that NVIDIA can knock it out of the park and not be rewarded after their earnings? Of course. What about Micron knocking it out of the park? They were down after their earnings. That will probably be our new normal. For any stock that is AI based and gaining the majority of their gains from artificial intelligence, they'll have great earnings. They won't be enough, so they'll pull back 10, 15%, and then they'll march higher 2 to 4 weeks after their earnings. That is our new normal. We should be prepared for it. And then investors should stay clear of these stocks to be targeted for tax loss. They're sitting right here. Lululemon, Fresh Pet, Caesars Entertainment, Target, General Mills, Heinz Craft, Bell Resorts, Crocs, Colte, and Constellation Brands. These ones that are doing really pretty poor year to date. So these are the ones that you would expect to see harvested for tax losses. If you're interested in putting puts on something or being a contrarian, playing something to the downside, here's what you have right there. And then, of course, Trump could start taking sharp measures. In all honesty, it's easier to fire people than to furlough them. Don't be surprised to see the Department of Health and Education and the EPA take a serious hit. It's interesting because you hear people talk about a clean bill, and very rarely, if ever, do I truly see a clean bill. But to extend the market, yes, extend the market. To extend the government and give the government money, the Republican bill was a 2-page bill. That's it. It was as clean as I'd ever seen a bill go through to push for giving the government more money. There's always something there. Throw this and throw that in. This is the cleanest bill I've seen since probably the 80s. The Democrats will probably come to the table sooner than later, and then they can work out the hammering out of Medicaid, Medicare, illegals, what we're going to be paying them or not. I don't know the whole story there, but the longer it takes, the more government jobs are going to be lost, and it's going to shift those people into the private sector. We'll see what those people's job skills are worth. With that said, what questions do you guys have for me today? What questions can I go over for you? And I forgot about that one. Expectations for AI. I think AI expectations are that those stocks will continue to move the markets. I'm going off of the growth. And I think they're still going to move the markets because of the growth. Are there going to be winners and losers? Yes. Biggest loser, I think, in AI is going to be Intel. Government run for now, government influenced for now. That is not a recipe for success. The moment a government gets into a company, it usually seems to be all downhill. Well, Kevin, the government got in and owned a bunch of General Motors. Not impressed. Hundreds of employees lost their pension. Government did really well. Notice how those shares were bought back and they profited from them. Yes, the government saved the company, but it was not helping them through that 5.5 to 7 year period. The more the government gets into companies, those are most likely going to be the losers in the AI arena. I do like some chips. Some chip stocks are going to be really good to power the AI. Well, Kevin, what about the power? Should we be investing in energy? No, our grid's not there. The only, solar power, not a chance. You can't use sometime energy, wind energy, sometime energy. Those sometime energies are not going to power this. They're literally going to be building their own nuclear reactors. That's the only way that AI moves forward. Otherwise, we're all going to look like California and have 4 hours a day where you can't run your AC because it'd be too hot. And those power have to go to somewhere else. A lot of people ask, why did I leave California and LA? Shocking. During summer, they have what they called brownouts, where you couldn't use power. There was no power to your home for 4-hour periods of time. You don't open up freezers. You don't open up your refrigerators. You don't have any AC. Ridiculous. All right. Hopefully that answered the questions on AI expectations. Any other questions you guys have? If not, expectation, we'll see our market kind of slowly move higher. Bank stocks next week. Material and tech start the week after, and then the last week of October, first week of November, we get the big ones. The big bellwether AI stocks are going to report then. I don't see any questions coming up. Any questions for Nate or for Bryan? Newbies. So Lee just said, power limits are ridiculous, but so are a lot of Trump policies. Well, I'm going to just say Trump had no power limits, but definitely a lot of Trump policies, and let's not limit it to Trump. There are some of the cabinet policies that you will scratch your head on. The short answer is I did like the way that some of them came to pass in the first term, and we'll see what he does. I am more for a small government. To a certain degree, if Gupta's here is going to beat me, maybe Mod will beat me as well. I'd love to see smaller healthcare, education, EPA. I would love to I want to trim those down to nothing, put it back to the states and let the doctors and the environmentalists take care of it on a state by state level. I think it's the organizations had too much bureaucracy to get anything done. Too many people, too many chiefs. Nothing in those particular three agencies seem to be getting anything done. Get it back to the states. Get it back to the doctors. The doctors know better anyway. They're the ones that are doing all the work. I think it's pretty foolish on Trump's side to be cutting so much of the research and development. That's going to hurt our country in the long run. If you cut a bunch of the budget out of the health services sector that was related to vaccines and pharmaceutical production, we will fall behind. You're going to see most of that coming out of Asia and Europe. Well, yes, it can fall on the companies themselves. When it falls on the companies themselves, the vaccines and the things that do work are really, really expensive. So there's got to be a give and take where the government funds some of these challenges because let's face it, 99% of them don't come to pass. It's wasted money. It's wasted money, and there are things that we're going to find out how we end up in the long run. Good point. Anyway, okay. All right, let's see. I don't see if I see anything else here, but Abraham sent me a link. I'll check on that. All right, guys. Hey, appreciate you being here. Look forward to seeing you next week. Just as a heads up, Wednesday, Thursday, Friday, I am going to be out of the office. You will not believe it, but I'm going to be inducted into the High School Hall of Fame and the County High School Hall of Fame. So I got to go sit like I've actually did something important in football, baseball, and in high school. So kind of surprising. My wife said, "Wait, you're getting what?" I said, "Yes, honey. I'm being inducted to the High School Football Hall of Fame and the County Football Hall of Fame." Tony Gonzalez came through in my years, so it's funny. I'm going to sit at Tony's table, and he's going to look at me and say, "What did you do after high school?" And I'll be saying, "Absolutely nothing in sports. Good enough to make some college teams, but never good enough to play." Good night, everyone. Appreciate you being here. Look forward to seeing you next week. Have a great week, and let's keep seeing our accounts grow. Good night, everybody.